Have you started to save money for a home purchase? And you're wondering, what's the difference between coming in with a smaller down payment versus a bigger down payment? Well, you're in luck. I'm covering everything you need to know about down payments. Let's start by explaining in simple terms what a down payment actually is. Home purchases are composed of two elements: the mortgage loan you borrow and your own money that you bring into the transaction. For example, if you're buying a $700,000 home and you want to invest a 10% down payment, that's $70,000. So you'll borrow $620 from the bank. You'll bring in $70,000 on your own, and when you combine those together, that makes a $700,000 purchase. Another way to look at it is a down payment is your liquid money that you're bringing to the table. It cannot be another loan. It cannot be a credit card. It's actually green dollars that you have in your accounts. Down payments can range anywhere from 3% to 20% or more. Yikes, that's a huge range. Exactly. That's why we're talking about it today. Let's put those numbers in perspective. 3% of a $700,000 purchase is $21,000. 20% of that purchase is $140,000. That's a $119,000 difference. Wow! So the question on the table is, should you just save up the $21,000 and hit the ground running, or should you wait and save the full $120,000 before you go home shopping? Well, the answer is, it depends. Do you want to save money up front, or do you want to save money on a month-to-month basis? Let me explain. The size of your down payment will affect your monthly mortgage. Think of this relationship as a seesaw. On one side, you have the down payment, and on the other side, you have the monthly mortgage. As your down payment goes up, your mortgage goes down. As your down payment goes down, your mortgage goes up. Let's use a $700,000 purchase and see how that works on the seesaw. It's $21,000 for a down payment if you opt to go for just 3%. So $21,000, that's a lower down payment, but your principal and interest is this scary number here. Whoa, above $4,200. Now, if you go with 20% down payment, that's a big down payment. It's $120,000 on this side, and your mortgage drops all the way to about $3,500. That's a savings of over $700 a month if you choose to go with the bigger down payment. Nice. But if you choose to go with the lower down payment, you just saved $119,000 up front. Also nice. So you see, it really depends on what's more important to you. Here are some other things to consider. Mortgage insurance. With a 20% down payment, you avoid mortgage insurance. Anything under 20%, and I mean anything, it can be 19%, 18%, anything under 20% gives you an additional payment per month that goes towards mortgage insurance. For a purchase of $700,000, that mortgage insurance can be anywhere from $300 to $400 a month. And those $300 to $400 will be added on top of the principal and interest number we saw previously. Getting in the game sooner. If you opt to go with a smaller down payment, you don't have to wait as many years to save money, so you can jump into real estate sooner. And this is a smart move. It allows you to start building equity. And even if your first home wasn't ideal, the sooner you start building equity, the sooner you can tap into it to upgrade to your forever home. Emergency fund. If you choose to go with a smaller down payment, you'll have some liquid cash left in the bank for a rainy day. This is especially a smart move if you're a first-time home buyer, you're not familiar with the upkeep of a home. And if you buy a fixer-upper, you can use that extra liquid cash that you held on to for remodels. Bottom line, when it comes to large versus small down payments, there isn't a one-size-fits-all. It really depends on your financial goals and where you are in your life journey. Want to hear my personal take? Okay. As long as you're not stretching yourself too thin with that monthly payment, jump in the game as soon as possible. even if it means a smaller down payment. Why? Well, the sooner you start, the less you'll pay overall. The trajectory of real estate is upward. And once you're in a home, it'll start building equity. And the combination of the equity building and you paying off your principal loan will eventually get you into a place where you can refinance into a 20% down payment loan, thereby eliminating that mortgage insurance. I'm Melissa Urena, Long Beach Local and SoCal Realtor. My mission is to help homeowners like yourself go from first home to forever home. Make sure to like and subscribe for more tips on buying and selling in Southern California.